Okay, let's dive right in. What a week in the crypto world, huh? Bitcoin went absolutely bananas. I mean, soaring past $100,000 like it was nothing. And then, bam, just as quickly, it dropped below $95,000. Talk about a roller coaster.
Absolutely, a real head spinner. And what's really interesting is trying to understand the underlying forces causing such dramatic swings.
Right. What was behind that initial jump?
Well, the jump above $100,000 seemed to be fueled by kind of a cocktail of positive sentiment.
Okay.
You had gains in the stock market suggesting broader economic confidence. Then the initial hints of a U.S.-U.K. trade agreement pointing towards maybe more global stability.
Uh-huh.
And of course, the, continued expectation that President Trump's administration might take a more lenient approach to crypto regulation.
So like a perfect storm of good news for the bulls, but then that dip. Was that just the market catching its breath, or was there something more sort of fundamental at play? I think the drop below $95,000 signaled a shift, a more cautious stance, really.
Investors were likely looking ahead to the Federal Reserve's upcoming announcements. Any indication that the Fed might tighten monetary policy.
Which makes risky assets less attractive, right?
Exactly. Steps to decrease the money supply, maybe increase interest rates. It tends to make things like cryptocurrencies less appealing, borrowing gets more expensive, safer investments look better.
Right. Makes sense. And there was also that May 5th deadline, the expiration of some Bitcoin-related order tied to Trump. Did that contribute to the market jitters at all?
It's tough to say exactly how much of an impact that specific order had, but, the expiration of any potentially influential directive like that can introduce uncertainty.
And markets hate uncertainty.
They really do. So it likely contributed to some of the speculative trading we saw around that time. The lack of a clear follow-up probably left some investors wondering, what's next for the regulatory landscape.
Yeah, definitely something to watch. Now, Bitcoin's wild ride is grabbing headlines, obviously. But it wasn't the only big story this week. Coinbase made a massive move, shelling out $2.9 billion to acquire Deribit. That's a serious chunk of change.
It is a significant investment, and it clearly signals Coinbase's ambition to become, well, a dominant force in the crypto derivatives market.
Okay, let's break that down a bit. Derivatives, options. What does that mean for someone maybe newer to this?
Sure. So derivatives in finance are essentially contracts. Their value is tied to an underlying asset, in this case, cryptocurrencies like Bitcoin and Ether. Options specifically give the buyer the right, but crucially not the obligation, to buy or sell that asset at a specific price by a certain date.
Okay.
It's a more sophisticated, potentially riskier area compared to just buying and selling the coins themselves, what we call spot trading.
Right.
And Deribit happens to be the world's largest platform for these Bitcoin and Ether options. So this acquisition gives Coinbase immediate access to a huge, very active market.
And that $2.9 billion wasn't all cash, was it? I saw it was a mix.
That's right. A combination. $700 million in cash and 11 million Coinbase Class A shares.
That's a real commitment, using their own stock like that. Why go so big into derivatives now? What's the strategy?
Well, that mix of cash and stock is pretty smart strategically. The cash gives immediate value, sure, but using stock helps align Deribit's team with Coinbase's long-term success.
Makes sense.
If you think about the bigger picture, this acquisition suggests Coinbase is looking beyond just, helping people buy Bitcoin. They want to offer a much wider range of investment products, services globally, and the derivatives market. That's a key part of that expansion, is where more sophisticated traders operate and, frankly, where significant fees can be generated.
Okay, interesting. Feels like governments are also starting to pay closer attention, maybe get more involved. We saw some developments there this past week, particularly in the U.S. New Hampshire became the first state to actually establish a cryptocurrency reserve. That's pretty noteworthy, isn't it?
It absolutely is. Very noteworthy. By allowing the state treasurer to allocate up to 5% of public funds into Bitcoin, given its current market cap, that's really the only one that qualifies right now.
Ah, okay.
New Hampshire is sending a very strong message. This move, while maybe small in the initial dollar amount, could be a huge symbolic step.
How so?
Well, it might signal a growing acceptance of Bitcoin as a, dare I say, legitimate reserve asset at the state level that could potentially influence how other institutions, maybe even individuals, perceive it and interact with it. The long-term implications for state treasuries diversifying like this could be substantial. But it also carries new risks, obviously, risk management considerations. Will other states see this as viable? Or just a risky bet? That's the big question you have to ask.
And Arizona also had some crypto-related news, House Bill 2749. How does that compare to what New Hampshire's doing? Is it similar?
Not quite. Arizona's approach is different. It's more about managing potential liabilities, really.
Yeah.
Their bill allows the state to hold unclaimed cryptocurrency property in reserve, but they aren't actively investing public funds in it.
Ah, I see the distinction.
Yeah, so it's more about what happens to digital assets that, legally end up belonging to the state rather than a proactive investment strategy like we're seeing up in New Hampshire.
Gotcha. So New Hampshire is actively saying, we see potential here, we're putting money in, while Arizona is more like, okay, if crypto ends up in our lost and found, we need a plan.
And didn't New Hampshire have another bill too, House Bill 302?
Exactly. They doubled down. House Bill 302 really solidifies their intent. It provides the specific legal framework for state officials to invest that up to 5% in major cryptos alongside precious metals.
Yep.
It's a clear indication this isn't just a one-off idea, but a deliberate policy direction for the state.
Interesting. Meanwhile, across the Atlantic, the UK seems to be making some pretty positive noises, trying to become a leader in digital assets. Matthew Osborne from Ripple seemed encouraged. Yeah, what's fascinating in the UK's approach is the explicit goal of fostering innovation. They're talking about clear, forward-looking regulation. Chancellor Rachel Reeves has emphasized needing a flexible, competitive environment to attract crypto businesses, attract investment. Osborne's positive comments, well, they reflect the industry recognizing that proactive stance.
So it's kind of different paths emerging.
It seems so. If you connect this to the U.S. developments, you see a contrast, right? Some U.S. states are experimenting, kind of piecemeal, while the U.K. seems to be aiming for a more comprehensive national strategy.
Interesting to see how those different approaches play out. Now, shifting gears slightly, we also got Coinbase's Q1 2025 earnings report this week. Revenue was up, which sounds good on the surface, but net income was down, and it didn't quite meet what analysts were expecting. The market reacted with a bit of a dip in their stock price after hours.
Yeah, that's a crucial point. While a 24% year-over-year increase in revenue up to $2.03 billion certainly looks positive,
It does.
the drop in adjusted net income down to $526.63 million from almost $680 million the previous year, and falling short of analyst estimates, that clearly raised some concerns among investors.
And the stock dropped almost 3%.
In after-hours trading, yeah. It underscores that immediate market reaction. It suggests that, despite bringing in more revenue, Coinbase might be facing increased operating costs or maybe other factors hitting their profitability. Investors are always keenly watching that bottom line.
It's a good reminder, isn't it? Top-line growth doesn't always translate directly to profit, especially in a dynamic, competitive sector like crypto.
Okay, looking ahead a bit, we've got some major crypto conferences coming up, May and June. What kind of impact do these events typically have on the market? Do they move the needle?
They often do, yeah. These conferences can serve as significant catalysts in the crypto world. They're a platform for companies to unveil new tech, announce key partnerships, share their future visions.
So lots of news generated. Exactly. And the buzz, the discussions generated at these events can significantly influence market sentiment. Positive announcements can lead to increased investor enthusiasm, more trading activity, potentially driving up prices for certain coins or assets, at least in the short term.
Kind of like an industry showcase that creates excitement, maybe some FOMO.
Precisely. It can really inject some energy and, volatility into the market just by bringing everyone together and sparking those new conversations.
Okay. Finally, the last piece of the puzzle from this past week, Bytrace's report. Warning about a potential new crypto winter. That sounds a bit gloomy after hearing about acquisitions and state reserves.
It does create a significant tension in the narrative, doesn't it?
Yeah.
Bytrace's analysis points to a potential downturn, and they're linking it to negative sentiment in the broader financial markets, particularly stemming from uncertainties related to global tariffs.
The macro picture.
Right. Their report suggests that despite some of the optimism we've seen in the crypto space early in 2025, these larger macroeconomic headwinds could still lead to a substantial contraction in the crypto market.
Wow.
And this raises a really important question for you to consider. Can the positive developments we've just been discussing, like, increase institutional adoption, big moves by players like Coinbase, even some regulatory progress, can these factors outweigh the potential negative pressures from the wider economy?
So we're seeing this real tug of war. Positive steps inside crypto adoption, infrastructure building, but maybe a storm brewing on the horizon because of global economic stuff.
Yeah.
It definitely makes for a complex, uncertain picture.
Exactly. We've seen Bitcoin's dramatic price swings reflecting that immediate sentiment. We've seen a major exchange making a huge long-term strategic bet. Governments starting to dip their toes in, but in different ways, a mixed bag of earnings from a leading platform, and now a stark warning about a potential market downturn.
It's a lot to juggle.
It is, and these aren't isolated incidents. They're all interconnected pieces of this rapidly evolving landscape. For you, keeping track of these different forces, understanding how they interact, that's going to be key to navigating this space.
Absolutely. It really feels like we're at some kind of inflection point. So the big question to really think about then, I suppose, is this. With all these conflicting signals, the innovation, the regulation, the economic anxieties, well, we're just in a period of maybe necessary consolidation, strategic maneuvering before the next big wave of growth in crypto, or are the warnings of a crypto winter accurate, suggesting maybe a more prolonged period of challenges ahead?
Yeah. How
How these different threads ultimately weave together. Well, that'll be truly fascinating to watch. Hopefully, this deep dive has given you a clearer lens to view these developments and form your own perspective.